Every month, without knowing it, a teacher in Ohio, a nurse in Manchester, and a factory worker in Osaka do the exact same thing. They send a slice of their paycheck into a fund. That fund buys stock. Multiply that by hundreds of millions of workers, decade after decade, and you get something strange. Retirement savings, meant to protect people in old age, have quietly become one of the main forces holding up the entire stock market. Nobody voted for this. Nobody designed it on purpose. It just happened. And now, it's too big to stop.
Here's why that should matter to you right now. Pension funds, sovereign wealth funds, and retirement systems collectively control tens of trillions of dollars worldwide. A huge share of that sits in stocks. Not because managers love risk, but because bonds no longer pay enough to cover the promises made decades ago. When interest rates stayed low through much of the 2010s, pensions couldn't hit their required returns sitting in safe government debt, so they moved into equities. Public pensions in the United States alone hold well over $1 trillion in stocks. Add corporate pensions, sovereign funds, and retirement systems from Canada to Japan to Norway, and you get a wall of money that never really stops buying. That's the part most people miss. This isn't hedge fund money jumping in and out, chasing momentum. This is slow, structural, recurring money. Every payday, more contributions arrive. Every quarter, some of that has to be invested, not because the market looks good, because the paperwork says so. Think about what that really means. A huge chunk of stock market demand isn't driven by belief in a company's future. It's driven by a calendar. Contributions come in, allocations are set, purchases happen. Recession or boom. Here's where it gets uncomfortable. Pension funds don't just choose to buy stocks. They're required to. Most defined benefit plans must hit an assumed rate of return, often around 7% a year, to stay solvent and pay retirees what they were promised. Miss that number? And the gap gets filled by taxpayers, employers, or by cutting future benefits. So the fund isn't asking, is this a good time to buy? It's asking, how do we hit 7% no matter what? That single number quietly forces enormous pools of capital into risk assets year after year, almost regardless of price. And here's the part that should really catch your attention. Because pensions need steady buying to stay solvent, and because so much retirement security depends on stock prices staying high, there's an unspoken alignment between governments, central banks, and markets. Nobody says it out loud, but a serious, sustained crash doesn't just hurt investors. It blows a hole in pension solvency worldwide. Underfunded pensions become a political crisis, not just a financial one. So there's real pressure, structural and political, to keep markets from falling too far for too long. That's not a conspiracy. It's incentive. When the thing propping up retirement security is stock prices, protecting stock prices quietly becomes policy. Now, the hidden math nobody puts on a slide. Many pension funds are still underfunded relative to what they've promised. U.S. state and local pension systems have faced funding gaps in the trillions, even in strong market years. Permanent, because contributions never stop. Price-insensitive, because the fund still has to buy on schedule, whether the market is cheap or expensive. Zoom out further, and it gets stranger. Because pension money is so enormous and so consistent, some economists argue it's one of the quiet forces behind why markets have kept climbing over the long run, through wars, pandemics, recessions, not because every company deserves that valuation, but because there's always another wave of retirement contributions that has to go somewhere, which raises the real question. What happens when that wave slows down? Populations are aging. In many developed countries, the ratio of workers paying into pension systems compared to retirees drawing from them is shrinking. Fewer new contributions, more withdrawals as retirees cash out to live on. If that balance tips far enough, one of the market's most reliable buyers could quietly become a seller instead. Nobody knows exactly when that tipping point arrives, but the direction is already visible in the demographics of Japan, much of Europe,
and increasingly the United States. So the same mechanism that helped inflate and stabilize stock markets for half a century may, over the coming decades, work in reverse, slowly, not with a crash, but with erosion. Less buying pressure here, a little more selling pressure there. The kind of shift that doesn't make headlines until it's already reshaped everything underneath them. Your retirement account was supposed to be the safe, boring part of the financial system. Instead, it may be one of its most important engines. And like any engine that's never allowed to stop running, the real question isn't whether it keeps going. It's what happens the day it has to slow down.